and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. We're about 2 minutes late because I was totally engrossed in an AI article. I'm sorry, D.
Yeah. What? So you want to share?
We'll get to it. Let's do the disclaimer first, and then I'll tell you.
Sure. So before we get started, everyone, keep in mind, Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
Anyways, so CNBC started talking about, I guess it's a New York Times article, and the columnists had gone through, OpenAI, which we've talked about here. I mean, it's been around for years, right? But they just opened it to the public, really, to kind of experience through the chatbot different, communications you can have with the internet, basically. And so this columnist started going down like a very disturbing rabbit hole with Bing, because Microsoft has attached it. So now, and invested, a serious amount of money in the platform. And, the chat or the AI or Bing, the chatbot basically came back with some very disturbing feedback, world ending type, commentary.
Oh, really?
Like that it wants to hack the entire, world's computer networks and all sorts of, I'm just scratching the surface, but it you wonder what it does to, Microsoft stock, it's interesting.
Yeah. Like Terminator, right? Isn't that what
exactly. Like everything we've, what was the Space Odyssey movie where the AI basically, destroyed everyone who's in space. I forget, but they're using this article as an interesting piece where there could be some negative effects, right? And it's not all positive.
Right. So, no, I didn't see it. It'll be interesting. I'll take a look at it.
I wonder if it's doing anything to Microsoft stock in the pre-market, but whatever.
Yeah. No, well, definitely. I don't know. A lot of you may have not seen it, Terminator with Arnold Schwarzenegger, but I think that's what happened, where they're ahead of their time in the sense that there were no AIs at that time. But what they were saying is that the computers will try to basically take over and go to war with human beings. And
Matrix as well, right? That's Matrix.
Oh, Matrix. Yeah. So there are Hollywood warnings there. All right, let's get started. If anybody's joined us for the first time, we do the show every morning really to help answer any questions you may have about Market Chameleon tools, data, analytics. And if you wanted to come on the show and talk about strategies or something unusual you've seen, you're welcome to come on the show and talk about that as well, because I think that will benefit the rest of the members in the community. Two ways to ask the questions are to put your questions on the live chat on YouTube. Will's watching it and he'll read them back to me. If you want to come on a show and ask your question live, we also provide a link to Zoom. Click on that link. It takes you over to Zoom. Once you're in Zoom, you don't have to turn on your video camera, but once we let you in, everybody could hear you. You could ask your question, navigate as to what you're looking at. And while we're waiting for any questions to come in, we give you guys a little bit of time. We'll start out taking a look at the pre-market report to get some insights, what's trading in pre-market hours. If we don't get any questions, I'll navigate to a different part of the website to see if we could look at what's going on and if we could use the tools to get some insights from that. So let me share my screen here. We'll start out with the pre-market report. These are stocks trading in the pre-market hours. We have a list of our most active stocks, our biggest percentage gainers, biggest percentage decliners. Coming down, and I see 46 stocks made our percentage gainers list, 146 on the decliners. So from this perspective, right now we're looking like we're lining up for bearish bias at the open. And when you guys look at this list, you could see that the list has stocks that are low cap stocks. So here are the market caps here. All right. We have ETFs in there. We could have closed-end funds, preferred stocks, rights units, anything that trades on the major US exchanges. If it's trading in pre-market hours and meets certain thresholds, our thresholds, it could make this list. So we want to try to narrow down the list to get some better insights. And what I usually do is just show the S&P 500 companies. To do that, we could use the filters here above to narrow down this list. And this one in ETF, when you click on it, you get a drop-down menu with a list of different ETFs. The first one here, SPY, that's the S&P 500 ETF. Probably everybody knows that already. When you select it, click on it like this, the list below will get filtered by stocks that are holdings in the SPY ETF, which are the S&P 500 constituents. And here we see 2 made our percentage gainers list, 22 on the decliners. So again, from this perspective, it looks like we're lining up for a bearish bias at the open. And of course, we've had some pretty bad inflation numbers come out. I think that, the markets was kind of positioning for inflation to start easing more, thinking that the Fed will start, slowing down or getting close to their peak rate. But now we're getting a lot of conflicting data, and we are seeing that 10-year bond actually starting to tick back up. Right, I think that it fell almost down to 3.5%, I believe. Now it's starting to head back up to the 4% range, given some of the data coming out and what some of the Fed officials are saying. I think that at least 2 Fed officials are not said that they're not against another 0.5 point increase. So we downshifted, we might come back to upshifting, and that's weighing in on these stocks. So I don't know if we got any questions. We gave them a couple minutes. If not, I'll just navigate to a different part of the website.
Nothing popping up, D.
Okay. Let's go. We did this the other day. I'm going to go under our articles. And in these articles, you guys all have access to it. What we try to do, a lot of them are auto triggered to kind of, give examples of ways to use some of the MarketChameleon tools. And let me come down here. Here's QQQ, bearish calendar spread. So let's click on that. And this was generated using, the tools that you could use on MarketChameleon, that, either screeners or your analysis, but it kind of went through different analytics. It hit some thresholds, so it produced this, trade idea in QQQ. And what it did was trigger a certain calendar spread. So it's a calendar put spread, which is a time spread where you buy an option in 1 month, one expiration, versus selling an option in a different expiration on the same strike. Okay, that's why it's calendar put spread. So same strike, different expirations. And this one was triggered. We'll go through the article. Why was it triggered? What are the main points that triggered it? And it's kind of a starting point to take a look at it further. If, of course, your outlook lines up with this particular strategy. Okay, so each strategy has a particular outlook, either in the stock, the volatility, the range, could be dividend, interest. So strategies do have particular, outlook on certain things. So let's take a look at what this one did. This is QQQ calendar spread, and one is it's telling us this is a bearish play on the stock with a target price of 287. Okay, so again, that would be the outlook of the strategy. All right, and if your outlook doesn't line up with it, then it wouldn't be a good strategy for you. But if that is an outlook that does line up with it, then we can take a further look at it. And a couple more things that it's telling us is that the upside to this strategy is plus almost 400%, 392. So payoff 1 to 4, and it's 13% undervalued. Okay, so a couple things, important things that triggered for us, and we'll kind of go through that logic when you evaluate a trade. All right, so what do we want to know when we evaluate a trade? Number one, does the strategy line up with my outlook? What do I stand to make versus lose, my risk and reward? Well, was that
Yep.
something just there's a voice?
Yeah, we had to. I don't know why the sound went on, but we had to start the webinar in order to have people click over if they want to ask questions. Usually doesn't have a sound attached to it. There you go.
Okay. Yep. So what are the important parts that we're discussing here? Really quickly, does the strategy line up with my unique outlook, particular outlook? What is the risk reward? You always want to know that ahead of time, because I want to know, well, what do I risk to lose here, and what do I stand to make? And the other thing is, if I enter this strategy, is this price a good price? Is it realistic? Am I way overpaying? Am I maybe getting a little bit of a better deal? Is it fair value? So these are the things that quickly this article goes through, because that's what the scan and the analysis went through. Okay, so here, number one, it hit a QQQ, yesterday, that it hit that there's things that were trading in the market that looked bearish. Okay, so that's why it triggered a bearish outlook. Okay, it said, okay, we don't know where QQQ is going, but right now, given the circumstances at this moment, things started to look bearish. Okay, remember, it's not a forecast tomorrow or the day after, or whatever. It's just looking at the data and information at that moment, and said, given this information at this moment, things started to look bearish the way it was trading. So you could see here, today's price action is showing weakness in both stock and overall market. Doesn't go into like a whole article, but that's the point that in the background it detected. And then it said, okay, if that continues, right, that this calendar spread, the way it's set up, because you could set up a calendar spread to be bullish, bearish, neutral, you could do double calendar spread. But the way this calendar spread is set up is that it has a bearish bias to the 287 strike. So the stock right now is 303. And by setting this calendar spread to 287, the strike is below where the current price is, meaning that a drift down, especially to the 287 strike, that's your optimal, that's where you want the stock to go to, is indicating a bearish bias. You want a negative drift to that strike. All right. And if we want to visualize it, this is kind of what a payout diagram or an options profit calculator, this is what it's shown would look like at the first expiration. So here are the legs. You're selling the March 31st 287 put versus buying the April 21 287 put. Okay, so you can see same strike, different expirations, right? Selling the near term, buying the outer term, or buying the longer dated, right? Selling the shorter dated, buying the longer dated option. That's the setup. For a debit, We took at the time when we took a snapshot of this, of course, prices are always changing, but at that moment that we took a snapshot of the markets, if you basically paid the market, bought on the offer, sold on the bid at that moment, it was $1.53 debit. So let's come down here. And of course, this strategy, when we talked about calendar spreads, it's a little bit tricky to calculate the profit and loss at expiration because you have two different expirations, right? You have an expiration, one option's expired March 31st, one is expired April 21st. So how do you calculate a profit and loss at expiration when you have multiple expirations to choose from? So what we do is, number one, the system knows that at March 31st expiration, this option will expire. It will be either worthless or it's going to be in the money and convert into stock if assigned. And at that point, this no longer is a calendar spread. So this will no longer be a strategy, calendar put spread strategy. So that's when it picks that the strategy ends, March 31st. Okay, so then what happens is this payout diagram is based on March 31st expiration. See? Okay, but on March 31st expiration, there's another issue. Okay, we could calculate what this option will be because it's either going to expire worthless or be in the money, and we just have to calculate its intrinsic value. But we don't know what the price of this option will be because it's not going to expire yet. So we can't give it a zero. We can't say it's going to be worth zero on March 31st because it still has until April 21st to go. Meaning it still has potential, time value. And based on that, we don't know what the time value of that option will be because we need to know what the implied volatility will be on March 31st. And nobody's telling us that, right? Nobody tells us on March 31st, the implied volatility will be X. So since we don't know it, we go and have to create what we think a reasonable estimate is for this option. And the first estimate that we run is we set what is the median implied volatility for similar option, historically. Okay, so then the system's going back and saying, okay, what is an option with X days to go, all these other variables, what is the median implied volatility? And we start there, right? We don't know if it's going to be high or low, so we start using. So the first guess is it reverts to the median IV for a particular option, not the 30 IV, but for an option that's similar to this. And then it draws a potential diagram. And one thing that will change it is if implied volatility is higher, then this will be more profitable. If implied volatility is lower, it'll be less profitable because when you own an option that you're long Vega and the expiring option is gone, but that one option that you're long, you want implied volatility to go up. If implied volatility goes down, it'll be worth less, right? This is starting out the median. And of course, we could go to the options profit calculator and then start moving it around, looking at different scenarios. But the point here is that if we look at the graph and we use the median IV, our best guess, that we're risking, we of course, okay, we're risking $1.53, but there is a big potential upside too if we're right? 4 to 1. So it's not like, we're risking $1.53 to make a penny, right? Or to make 2 pennies. That might be already an unreasonable risk unless we, we think that there's like a guarantee or something, but there's not a guarantee. So what we want to do is first take a look at it and say, all right, if I'm taking on this risk and I don't know if the stock will, of course it could keep going up or it could, crash all the way down. But if this is my view and I feel strongly about it, then I stand to gain, almost 400%. Well, that might be a good risk reward trade, for you. Of course, every trade of risk reward, that's the individual trader, right? You have to decide. But here in this, instance, at least, you're looking at 4-to-1 payout. All right. So we took a look at that, and you could read about that here. All right. So two things so far before I keep going down the line and describing the rest of it. Just to recap, we found a strategy with a defined risk, right? So we know what we're risking. It's lining up. It should be lining up with our particular outlook. In this case, we have to have an outlook that we're bearish between now and March 31st with a target price of 287. And then we took a look at the risk, compared the risk to the potential reward. All right. So we're going through this and analyzing this trade. So what do we want to do next? So the next thing is, well, if we're paying $1.53 potentially, is this a crazy price to pay? Because we don't want to end up paying such a high price that even if things start going our way, right, the stock's starting to go down, but we paid such a high price that it will be very difficult, for this strategy to start moving up, right? Like, and an example I gave, and a lot of you, if you've been trading, this probably happened to you. You bought a call, the stock went up and the call went down, right? Or you bought a put, the stock went down and the put came down. So what we want to do is say, what are we paying? Are we overpaying? Are we underpaying? We want to know this because we don't want to end up paying such a ridiculous price for a strategy that even if the circumstances in the underlying go our way, we end up still losing money, right? We're trying not for that not to happen. We can't guarantee it, but we need to do an analysis so that hopefully does not happen. Okay, so we need to benchmark. Well, what do we think this strategy, would be worth? A theoretical value. We need to benchmark a theoretical value. What would, in theory, this trade, right, be worth? And we could go, and this is what the system is doing for us. It's saying, okay, based on the historical data, it goes back and compares what similar options, okay, with similar distance to the strikes from the spot price, with similar days to expiration, the similar spread between days, and similar circumstances in IV and all that. It's going back in history, trying to line up what is usually the average price of this spread, right? Because if we could buy it below average, then we have maybe even a good chance that it comes back to the average. But if we're paying way over, we have to have a good reason, right? Because then why are we paying such a high premium? So in this circumstance, what it's saying is, on average, it went through all the calculations for us and spit it out that this spread theoretically is worth $1.75. Okay, so at today's market of $1.53, that would be 13% discount. Okay, so that's what we're trying to do, is say, okay, are we paying a realistic price? And think of it like this. You could get really excited about, I don't know, buying a beach house or piece of real estate, and then you just go out and just pay the offer. But if you did that without seeing, well, am I paying a reasonable price? Like, what are similar houses around here cost, and what are they sell for? You could end up paying such a high price that you really just missed out maybe an opportunity to buy even a better beach house at a lower price. So you want to, it's a sanity check. It's a comparison, like, am I getting a good deal? And if I am paying over, and sometimes it's okay, maybe you want to pay over the average because you think that it's justified, because there's a really high chance that your outlook, is gonna pay off. So but in addition to that, remember I said that $1.53, that's if we pay up for the spread on the markets. And we want to take a look at it. Well, maybe I could even get better. So the midpoint of it is $1.49. Okay, that's 4 cents better, but percentage-wise, it makes a difference. So there's room in there between the markets. What this is saying is that there's room on this spread to do even potentially better. That means maybe I could get $1.49, which would be great, because that 4 cents makes a difference for something that's $1.53, right? So whatever that works out to, 2.5%, 3%, but that adds up over time, right? So maybe I could even do better than that and get it at the midpoint, and that helps, your risk reward, right? You're now risking a little bit less, and since you're paying less, your reward, if it hits your ideal price, is even better. So that's another thing we want to go there. And here it compares it, that if you pay the market, it's 13% discount from the historical average price, $1.75. Here's the range. If you could get it at the midpoint, it's a 15% discount. So another 2% potential, from the midpoint. And we're right up at 9:30. So to wrap it all up, it's down here. What did we do in this short article? Came up with a defined risk strategy with a certain outlook in the stock, with taking a look at and comparing the potential risk and reward before we even enter into the trade, and evaluate the trade from the perspective is, are we getting a decent price or not? Okay, so really quickly, as a starting point, it got you to that point. Everyone,
awesome job, Dima. Remember, Monday is an exchange holiday, I'm pretty sure. I think it's President's Day. You have a great weekend, and we'll see everyone Tuesday, correct?
Yep, Tuesday, everyone. Everyone, thank you for joining. Have a safe weekend. Stay safe out there. Have a great trading day. We hope to see you guys on Tuesday. Thanks so much for joining.
Thanks, Dima. Have a great weekend, everyone. We'll see you on Tuesday. Bye-bye.